what is the setup for the overall markets. Let me welcome Ed Yardeni, President and Chief Investment Strategist at Yardeni Research. Along with that, we also have Jonathan Bharat, CIO at ETO Group, joining us on the show. A very good morning, gentlemen, and thank you so much for your time. And Ed, firstly, let me have your views on the upcoming Jackson Hole Symposium meet and what could be the commentary of Fed Chair Jerome Powell with respect to the key points that will be in focus, because Donald Trump has once again and keeps addressing him as Jerome Too Late Powell.
Well, I think the question will be, what sort of bird will Powell be? Will he be a dove? Will he be a hawk? Or will he be an owl? You know, owls just kind of sit there and watch. And I think he's going to be an owl. I think he's going to say, we're going to be watching the data. There are two more important inflation numbers that will come out. There's the consumption deflator that will be out for July at the end of this month. And then the August CPI will be out in September before the FOMC meeting. And then, of course, the payroll number will come out. I think the inflation numbers are going to run on the hot side. I think the payroll employment number is going to bounce back. And I think as a result, I'm not convinced that the Fed is going to, in fact, be cutting rates. I know the markets think so, but I humbly and respectfully disagree.
Jonathan, that's one piece of the puzzle, which way the Fed is going to move. The other one, of course, is oil, right? Because you had the U.S. Treasury Secretary saying India is profiteering with Russian oil. Your interpretation of the latest comments coming in from Scott Bessent, you think it's a tactic to exert pressure on India for tariff negotiations?
Yes, 100%. And I think you can go back to that, the playbook when we had Ukraine and Ukraine and the US talking, where the US current administration comes in there hard, does a lot of accusations, looking for everyone to come back to the table. And I think that, to me, was a shot by the US just to get this is serious. Let's try and get this back on the agenda. Let's try and get the agenda on oil, for one thing. But the tariffs discussion is all about bringing everyone back to the table to come up with a deal that actually works. I think it's a pressure point, but I also think it's got a pressure point to do with how the US is handling the situation between Russia and the Ukraine. And I think India is just on the side of that, but I think it's all encompassing.
Okay, so that's the view on oil. But Ed, once again, want to come to you for this entire comment coming in on too late Powell. In your view, is he too late? Is he just on time? Because while all looks good in terms of macros, you still have inflation that continues to be sticky. And some segments of the inflation, for example, services inflation continues to be above the US's target. So what do you think could happen in the September Fed meet? Does it warrant a rate cut just yet?
Well, I think that the inflation numbers that we have so far are not at 2%. They're closer to 3%. And it's not just tariffs, by the way. The services inflation numbers within the CPI, and I think in the consumption deflator we'll get later this month, I think they're looking still relatively hot. They certainly haven't come down back to where they were before the pandemic. And meanwhile, the tariffs have, in fact, had an impact on inflation. You can see clearly in durable goods inflation. So in the past, if services inflation remained relatively high or higher than the overall CPI, that would be offset by deflation in durable goods, and you'd be close to 2%. This time around, we still have services around 3%. And durable goods, which actually were falling, prices were falling a few months ago with the tariffs, they're now up 1.2%. That doesn't sound like much year over year, but it's no longer a significant offset to the inflation that's still running relatively hot in services.
Sure. Jonathan, I want to get back to the oil piece, because India is buying oil from Russia because it is cheaper. Refiners continue to prioritize economic considerations in their sourcing decisions, right? Your thoughts on India buying oil from Russia, and if India were to stop buying oil from Russia, what could be the impact on global, oil demand supply equation?
Look, I think it's you've got to source the correct or the cheapest oil to make your economy work. But it does come with a sting with the way the US has actually done it. To penalise, I've got to ask why President Trump hasn't penalised Russia in itself yet. I've got to ask why he hasn't penalised China yet, or is that coming out in the next couple of weeks? But to focus on India, I think is a little bit unfair. Because I think that an economy the size of India and the growth of India needs to look after herself, and to source cheap energy is just one of those in the equations. So I get a sense that if Trump can organise some sort of resolution to the Ukraine-Russian conflict, and Russia then puts more oil out into the market, then I think you'll see oil prices hit the lower end of the range, and that will benefit the entire globe. So if you take it all in one great big thing, one great big deal, then it does, at the end of the day, push oil prices lower, and that has to benefit all the economies. I do think that he's holding India out there as a negotiation point, which I think in the short term is very unfair, as I've mentioned. But if it comes to presenting a picture of unity to get the Ukraine-Russia situation out of the way, then I think Russia will put more supply of oil, and oil will trade to the lower end of the range, back around that US $60, $62 a barrel, where people can work with and economies can work with.
And Ed, what intrigues me is the posturing. I mean, look at the comment coming in from Caroline Leavitt, the US White House press secretary. She's saying that the US president has put tremendous public pressure to bring this war to a close, talking about Ukraine and Russia. And she's saying that he's taken actions, as you've seen, sanctions on India and other actions as well.
Well, I agree with all the comments that have been made here about the unfairness of focusing on India's purchases of Russian oil. And I also agree that I would prefer to see that we really squeeze Russia a lot harder. I mean, I'm surprised that we haven't gone full bore and imposed all the possible sanctions we could possibly impose on Russia over the past couple of years. Maybe this war would have ended even faster, but I'm kind of questioning whether Putin really wants a settlement here, and whether a settlement is going to be had. And I think we may find that the United States is still going to be in a position where it has to squeeze Russia even harder to get their attention. Because right now, Russia is going to get a sweet deal if there's a negotiated settlement right here, and they certainly don't deserve it.
Indeed, but Ed, given the rally in the US market specifically, are you also questioning the kind of move over there? Because yes, the inflation data for now, that seems to be quite comfortable. But going ahead,
Yes.
the tariffs might impact the economy in a different way. The markets are looking for and anticipating
Right.
for a rate cut. But what's your sense? From here on, where are the US markets headed?
Well, I think on a short-term basis, the rest of August into September, we're probably going to see the market trade down some. I think we may already have seen today some profit taking, particularly in the AI trade, which is clearly has aspects of a bubble. Even some of the people in the industry are saying that it may be a bubble. Way too much money being spent on expanding capacity without really any guarantee that it's going to earn a good return. So I think we may very well see some significant profit taking in technology stocks led by the AI companies. And that could continue to September, which is a very typical seasonal weak month. And then I think by October, we could be setting an opportunity to buy going into year-end with a strong year-end rally, which is, again, a fairly typical seasonal phenomenon. I think by the end of the year, we'll finish up at 6,600 on the S&P 500, but I would like to see the market broaden. I think we all would like to see the market broaden, and it every now and then teases us and suggests that it might be doing so, but then we see that that's not the case.
Okay, and Jonathan, before we let you go, just want to get your sense on the sanctions that have been put on Russian oil trade for India. How effective do you think they're going to be to dissuade India from trading with Russia? And if that actually pans out, who do you think in the market is going to fill that gap, and to what extent? Because most of the India's oil imports, they come from the Middle East, and barely 3 to 5% comes from the US. Does US stand to gain, or is this only being done to reduce dependence on Russia?
I think it's mainly been done to reduce the dependence on Russia and to try and squeeze. I think that if it's that small part of the equation that has been used as leverage. When we do see what the imposition of the 50% tariff looks like, and there are already cracks starting to appear in terms of that export market or import market into the US, and we're seeing that already start to play. So the strategy is to say, okay, well, this is what could happen. We want you to turn around. We want you to revise what you're doing out of Russia, put more pressure, still purchase your oil from where you normally get it at normal market rates. But we just want you to open your eyes to say, this is the goal we're trying to achieve. And I think there would be a conversation happen between the powers that be, Trump, Modi, saying, well, okay, this is what we're trying to achieve overall. We're trying to achieve a resolution to get import prices where we can support the current valuation in the equity markets, which we actually feel a little bit overcooked at the moment. So strategy to get oil prices lower, a strategy to also help to see asset values realise where they should be and not where they are at the moment.
I get that. Okay, Ed, Jonathan, both of you, thank you so much for your time today. Good speaking with you.
Thanks very much.
Okay, let's move on. Let's address